Hello, hello. Alrighty. What is up? What is up? Oh, my shirt's transparent again. I picked another blue V-neck shirt. I am a floating head. Hello, everybody. I'm your boss, Joe Boss. Welcome to another trade plan stream. The last one had terrible technical difficulties, so this is part 2. Hold on a sec. Eyes are kind of watering right now for some reason. Maybe it's because I have the lights. I've got backlights, and I wasn't looking at these lights, so maybe my eyes haven't quite adjusted yet to having the the lights right in front of me for the lighting here. But everything's set up for me this stream. Everything's good. So where we left off in the last stream is we were covering news from Axios. They have consistently had reporters in the current administration in the White House who have been able to get accurate reports about ongoing negotiations with Iran, with Cuba, of all sorts of things. So they have someone there providing Axios with credible sources, because we've seen Axios come out with a report a little bit while later there would be official policy from the administration, and then you would have a market moving event, especially in the case when it turns out Axios is... I haven't seen... Maybe there was one report Axios has come out with that in the last about month and a half that was probably incorrect, or actually call it 2-ish months now. But Axios has been quite consistent. So we went over a handful of reports in the last stream off the bat. I'm just also going to turn the music just a tad. And I'll go ahead and actually bring this up over here. And we'll hit publish on the streams. And let's see here. Follows the Islamic Republic of Iran. So this is some new stuff. You can see here's the Axios report that we were talking about. Trump convened a meeting with his senior national security team on the war of Iran this morning. That was yesterday. He is seriously considering launching new strikes against Iran, barring a last-minute breakthrough in negotiations, sources say. And now, today, we have a couple more developments. There was a meeting. Trump did have a meeting. Let's see here. That's my highly placed sources confirm that Iran has 24 hours to decide. So this is the process of the current negotiations. 24 hours to comply with a 30-day pause. I'll put it over here so it's in full. A 30-day pause that, if agreed to, clears the path for a 2-month consideration period and a 6-month ceasefire, subject to Pakistan's request. Report: the U.S. and Iran are close, quote unquote, to a trade deal to end the war, with remaining gaps focused on wording of points in the agreement. And then this came out not too long ago, around lunch. We can actually listen to this real quick.
Trump held a key phone call today with regional leaders on the months-long war. One diplomat calling that call very positive. Our coverage begins with Alex Hogan, live at the White House, where the president is spending this Memorial Day weekend. Hello, Alex.
Hi, Molly. So a lot of discussions taking place here at the White House today with President Trump, as you mentioned, telling Axios that he would hold a meeting with negotiators today to go over this latest deal with Iran. And one regional diplomat telling Fox News' Trey Yingst in the Middle East, quote, regional leaders were supportive of the progress and of the breakthroughs that President Trump achieved in these talks. We also heard the president say that it was 50-50 whether or not there would be a deal reached and that a decision would be made by tomorrow as of whether or not strikes would resume in Iran. We're also learning at the same time, President Trump telling CBS that negotiations are getting closer, so some progress there. Secretary of State Marco Rubio is in India today. He reiterated that the president has hard lines for a deal. Iran would not be able to have any nuclear capabilities. Iran would need to reopen the Strait of Hormuz and turn over any enriched uranium.
Alrighty. Should have gone full screen there. But, okay. Sealed the deal with 47. Netanyahu reportedly beside himself after a furious phone call with President Trump over Iran that left the Israeli leader, quote, with his hair on fire, per the Daily Mail. So, apparently Netanyahu did not like the agreement. So, right now, here are the deal points. Here, give me one more thing that's interrupting. One sec. Okay. Now, no technical difficulties, just a couple of interruptions. First, the text I had to get back to it. Oh, okay. Let's see. I don't care if Trump enters an intermediary ceasefire for Iran. They're already severely weakened. They don't hold the cards. On top of that, stabilizing gas prices before midterms is a priority. Right now, a big thing that will help the Republicans is economic stability and economic growth. Iran is unstable and untrustworthy, but if they break, they'll just continue to get obliterated. So I fail to see a downside here if Trump strikes a deal. Also, wouldn't mind finishing them off, so long there is a pathway to do that quickly, which I'm not sure there is. And I definitely agree with that. J.D. Vance apparently is on his way back to the White House. Unplanned return to Washington. This is just a review of everything that's happened so far. Now, the main points of negotiation, we're going to listen here to Marco Rubio.
I don't have news for you at this very moment, but there might be some news a little later today. There may not be. I
so
hope
maybe
there
after
will
the
be,
stream.
But I'm not sure yet. The question is about the Iranian issue, and as I said, there's been some progress done, some progress made. Even as I speak to you now, there's some work being done. There is a chance that whether it's later today, tomorrow, in a couple days, we may have something to say. But this issue needs to be solved, as the president has said, one way or the other. Iran can never have a nuclear weapon. The straits need to be opened without tolls. They need to turn over their enriched uranium. They need to turn over their highly enriched uranium. We need to address that issue. We need to address the issue of enrichment. These are the president's points consistently.
So those essentially are the deal points. If those are in whatever agreement is there, Trump will be happy, U.S. won't go in, and we won't gap down. We won't gap down according to this kind of historical comparison of prior gaps when we were more involved in attacking Iran. Okay. So with that all said and done now, we can focus on our charts and on our week-ahead trade plans now that we have caught up on the background. And a couple of updates and developments that occurred today that were relevant to those points from yesterday. So what I wanted to focus on yesterday was just focus on, hey, here's the gap down risk. And we're going to do nominal trade plans. So using these statistical indicators in the trading group to go over the nominal trade plan. So based on the historical odds, based off of what normally occurs, what are the nominal expectations? And so far, so good. So let's go ahead and say this is going, let's say conservatively, this is the outcome we're expecting in a scenario where there's no deal and an escalation. Now we're going to be looking at what is the scenario going to be when we have a deal that has passed. Well, we'll probably gap up. And prior gaps, we actually haven't really had a gap up in a while. But you can see we've had relief rallies come through on the S&P. And I remember there was a particular Tuesday. I think it was either that one or that one. There was a particular Tuesday that was especially bullish. I think that's Terraria music. Okay. So let's go ahead and look at some week ahead trade plans. And next week we can do some month ahead trade plans. I'm going to zoom in here. Make it a lot easier to see. Let's hide the dots. Wow, that's a busy looking chart. I think it's mostly because of these things right here. These little nodes. So I'm going to hide what are called the line stats, just so it's a little easier to see. So 26% of the time seasonally next week, the S&P closes between central pivot and our 0.5, which is about a 50-point range between 74.56 and 75.07. It's about a 51-point range. And let's see here. Odds of closing above central pivot does look a lot higher. That's about 15 points. Call it 8. We're talking maybe 25-ish points of closing next week below central pivot. So next week's generally considered quite bullish. It's about 70% plus of the time we end the week above central pivot. So if we do go below central pivot, let's look at our low odds for the S&P. Yeah, lows are pretty close. I'm pretty sure that's 46-ish, 45-ish% of lows next week seasonally are above this S0.50, and you can see probability weighted pivot is just below that. So I wouldn't be too surprised if we just make a higher low and continue on upwards in the more nominal trade plan scenario. Gotta move the monitor just a tad. So probably something along these lines here. Let's go ahead and add our timestamp. This is now the 23rd, 1419. Ayo, Ani. Nice to see you. Sorry, seems like it's my browser didn't refresh. It's all good. It's all good. Yeah, sometimes the live streams don't automatically start unless you do refresh. I always found that kind of annoying because, you know, you just leave the tab open waiting to start hearing someone talk, and they don't start talking for what seems like a bit too long of a period of time. They're like, better refresh. Better refresh. Better refresh. Okay. So this would be the expectation for pretty high move. We could see something even more conservative, but we'll see. I'm gonna stick with the kind of the net expectation that we'll see the close above central pivot, but I am not terribly too certain exactly where it's going to end up, because if we do get the deal for Iran and things continue to move normally, closing the week above this R0.5 here, you can see we have 11.5, 7.7. I'm rounding up there, right? It says 7.69, but 7.7. And then two more 11.5s. So we're more likely probably going to end up closer to that R1.5. So it would not be too unusual to see what you'd call a continuation bias setup work in this scenario, or a standard bullish bias. So this would be your standard bullish, right? And let's see here. What are the odds? We can actually look at the strategy dashboard for this real quick. Scroll down. We don't want range, we want continuation and standard. And let's have it quick. Okay. Pretty low odds of getting the entry to work. But much more likely to get the entry to work here for the standard bearish, or standard bearish and standard bullish over the continuations here. Odds of overshoot are pretty consistent, 15 to 19%. Stop loss odds are actually highest for the continuation bullish, and bearish odds, lowest stop loss odds are actually for the bearish odds here. For standard bearish. Let's see here. What else? Odds for closing in the midpoint are actually pretty darn high. So let me go ahead and unbias these real quick. And let's hide the drawings to kind of clean up the chart just a tad. I don't know. It seems to me like let's see. I'm trying to get what's going on with this close mid prices. Yeah, this is saying 38%. And real quick. Now, standard bullish. Yeah, I don't know about you, but this seems like a lot higher than that. That should be close mid, should be more than just this 26.92. So either some data is missing or something's going on with the dashboard. Oh, I know. I'm looking at the current week's odds, not next week's odds. And then when I look down here, yeah, you can see 40. Okay. Okay. Yeah. Let's see here. Dashboard. Yeah. I need to set up a tick here so then you can only have the dashboards show the odds for the next week, because the next week's is this bottom half. So I need to be looking at these odds down here. I'm like, these odds don't look so right. But that's for the current week that we just had. Okay. So that's what I was like, that doesn't seem correct. But then I go down here, I'm like, oh yeah, of course I did. Yes, of course I did the math correctly. Okay. I was like, it's just in a different spot. So yeah, bullish standard, bullish bearish, about the same odds. Actually, one thing I'll do. Let's see, can I move the position of the dashboard? Let's do bottom right real quick. There we go. Now you guys should be able to see it. Okay, let's see here. The strategy with the lowest odds of hitting your stop is the standard bullish at 38%, entry 26% of getting this specific entry, and then continuation bullish entry is also about 19%. So odds of either of these working is cumulatively about 46-ish%. Okay. Close mid is 48. Exits 3. So that means your odds of just hitting this exit with high odds. So your odds of just tapping that spot, not closing up there, but just tapping it, is 3%. And then 20% of the time you go past R2. So this is a scenario where, yeah, you could see a bullish continuation or a standard bullish bias play out well, but seasonally the odds of actually hitting these targets past R1.5 are not so great. So maybe targeting R1 is a more reasonable compromise. So from around here to here seems a little bit more reasonable. And maybe it's even a more subtle, less volatile move, depending on how developments with Iran proceed. Okay, and then let's go ahead and do a little sanity check. Let's go ahead and use the ranges here. Yeah, so it'd probably be just a bit up like that, and that looks fine to me. Maybe it's a little bit lower. Yeah. So something like this. Very similar to last week. Very, very similar to last week, essentially. Yeah, I'm still kind of skeptical on going close to that R1.5. I'm on the more conservative side as far as my expectations go. So maybe even down to like right there. That's more or less what I would kind of be expecting. Something actually a bit more range bound. Something like that. Again, if we get really, really good news about a deal with Iran, a deal that Trump likes, we'll end up with probably even higher prices. We'll probably get to the upper half of that $7,500 handle, just below $7,600. That would be my expectation. Because then you can remove all the people buying insurance and all the people buying options, trying to protect themselves from downside due to the Iran conflict. Won't have to buy that as much, and also oil should fall on that news, because it means that the oil producing countries in the Middle East can kind of take a sigh of relief. Makes sense. that we'd see a rally off that. So let's go ahead and continue on. We're going to go ahead and now, why don't we just cover oil? And you can see oil has not been matching our expectations, right? In the last stream, I said, hey, you know that if we looked back at ES, sure, we had this trade plan work out phenomenally, worked out beautifully, but I'm pretty sure we would have found, if we looked at some other charts, if we didn't have technical difficulties, we would have seen this. And yeah, right off the bat. And I mean, there's two right there, two expectations that aren't met. So just because I draw arrows with timestamps on them doesn't mean, oh, this is what's going to happen. Those are my expectations. Things change. But now, given the continued risk off expectation, I would imagine lower prices. So it looks like things are a bit more bullish seasonally around here. Right? Probably up to, I mean, maybe even R1. It looks pretty damn bullish. The when the odds are this high, it's really unusual not to get your high in this area. So we're going to just stick with drawing the nominal trade plan, which is the trade plan with the most likely probabilities. And because I have more bullish expectations going into the end of the week, again, nominally expecting that a deal is made, and we can go ahead and unbias these so we can get more information about what's on the low end here. Yeah, it would be range bound. Pretty much just staying range bound. From here down to here. Nice and simple. Let's go ahead and timestamp these. Oh, 05, 23. Sweet. Timestamp that one. And yeah, that's that. And I don't think I need the dashboard. Real quick, let's do another little sanity check with the range probabilities. It would be on the higher end here, so maybe we cross into the $100 handle one more time. Just past the $100 handle, I don't know if, maybe even 101. And then, oh, look, there you go. There's your peak down here. This is where you would expect bearish targets to be taken. So if you were a bear and you hit here, this is a pretty common place to hop out based on the distribution of weekly returns, where the low for the week usually occurs. Now let's go to DXY. So we covered an equity index, we covered a commodity, and we are now covering the currency. So real quick. Man, this is a nice song. Okay. Pretty good continuation odds here for the US dollar. But risk off would imply you're going up first. This is a pretty bog standard week, honestly, where you find just going down and then up like this. Again, looking at the nominal odds here doesn't mean that this is exactly going to happen. But real quick, yeah, something along these lines. And then using the seasonal data from the probability pivots to set those expectations. Yeah, essentially, unless we rip higher right at the open and we're not crossing below central pivot at the open, and then you essentially get something that looks like a little bit more crazy, that looks like this, right? Like getting this is a lot less likely. That would be my preferred outcome, but generally speaking, it's a lot easier to see prices move down, and those are pretty high odds. 60% of the time you're finding your low for the week on DXY next week, seasonally between central pivot and S1. And then most of your tops, like half of your highs, are between R1 and R2 next week. That's pretty good. That seems pretty good. So yeah, that's actually 60% of your highs. Wow. So I would be careful of an appreciating stock market falling oil. Would it be a rising dollar? Well, let's think about this. The way to interpret movement in the US dollar, people can get quite confused very easily, because sometimes when the world, let's say, is performing economically poorly, the dollar will rise. That's called being risk off. And the US dollar is considered a safe haven currency. So when things are really bad around the world, people will move their money into US dollars. However, when everything in the world is going hunky-dory and the United States is doing really well, people will still move their money into US dollars, because the US, it has the best companies, and so it's sucking in a bunch of capital. Dollar milkshake theory, right? But there's this middle ground between those 2 points, when the world is doing really good and the US is doing really good, and the world is doing really bad and the United States is doing the best of what everyone's able to handle, right? Their growth is essentially flat when everyone else is going lower. So those are the two, you could say, tips of the dollar smile. And then at the bottom of the smile, you have a scenario where the rest of the world is doing okay, or the rest of the world is actively growing, but the United States is not growing, or is in some kind of contraction. So it's essentially points in time when the rest of the world is outperforming the United States is typically when you would see relationships such as oil going lower and the dollar going lower, or equity markets going higher and the US dollar going lower. I have used that frame of reference much more successfully than purely viewing the US dollar as hold on. I need to stop my lock screen from locking me out here. Okay. 1 second. Oh. That was the key combination for locking me out. 1 sec. Lock, toggle locking. Yeah. There we go. Okay. Stop blocking computer when idle. Okay, great. Well, I wasn't necessarily idle. I was just talking. The computer couldn't tell the difference. Okay. So I've used dollar smile as an improved framework for interpreting potential directional moves for the DXY, for the US dollar. over just purely looking at DXY as a risk-on, risk-off asset. Because there's a lot of different factors that can change risk-on, risk-off, and because the US dollar is the world reserve currency, everyone really, really, really needs it. So that's why you end up with dollar strengthening in those two particular regimes, because when the rest of the world is growing, they're doing really well in their own right, but the US is growing the most, or is in the top 5, top 3 as far as growth goes, as far as opportunity goes. People need to buy US dollars to transact or to invest. So even with the rest of the world growing, the US is growing faster, and that begets more investment. Or in the scenario when things are going really bad, right? You have the entire world moving their money into safe haven assets, and that could be gold, right? That could be some other thing. It could be dollars, usually, most likely. Usually people move their money into cash, and then they move it into dollars. In that scenario. I mean, look at what happened with COVID. That was a big, big deal. And the US dollar only started awakening. And I remember this. On March 20th, 2020, the Federal Reserve announced that they were going to be opening swap lines with the other G7 central banks. So I'm like, what are swap lines? Essentially, it's an account where the Fed can print money and directly exchange one currency with another central bank for US dollars. And these swap lines effectively were unlimited for Bank of Japan, Bank of England, ECB. I mean, those are the three that come off the top of my mind, but I think there were 5. I think Bank of Australia, Reserve Bank of Australia was there. And Bank of Canada. I think those were the 5, if I recall correctly. And I recall vividly, even though it was like 5 years ago, because getting that email and then doing that research, figuring out exactly what a swap line was, and then figuring out, oh, this is going to be a way that the United States facilitates printing tons and tons of money, because so many people during the month when all the shutdowns were occurring and all the flights shut down and everyone was hunkered up in their homes, everyone was moving their money into safe haven assets. But gold wasn't even doing so great. People were moving their money into US dollars. US dollar was so staggeringly strong during that point in time. And there were lots of gold buyers, but the US dollar was getting so strong that other currencies were getting to dangerous levels, to the point where other central banks were saying, we're going to have to intervene in our economy and print ungodly amounts of money and create ungodly amounts of inflation. And instead, the United States stepped up and said, no, we'll take that brunt. And don't get me wrong, the rest of the world still printed money and they still had high inflation. But a lot of the stimulus we had was also, saving Europe again. We printed a lot of money for Europe. During COVID in order to help stabilize the euro and their economy relative to the United States, because so much money actually from Europe was flowing into US dollars and the United States for as a safe haven risk off play, because nobody knew how long or how damaging COVID would be economically, because nobody knew if it was going to go on for a few months, for a few years. And we saw it went on for essentially into the end of the year, but the COVID policies stayed in effect for probably longer than they should have. But that's all in retrospect, right? Now, at least the economic policies. So when the swap lines were finally conducted, The email on March 20th said, we are going to open the swap lines and begin spending all this money on March 23rd. Well, guess what happened on March 23rd on like 80% of assets? The bottom came in, right? The bottom for the market came in. Because that's when the US dollar started weakening significantly, and all these assets that had correlations started going back the opposite way, because now you were inflating. It wasn't necessarily the valuation of these assets necessarily improving. It was that all these assets were priced in US dollars and the dollar was devaluing. So it created this artificial low that people were able to, people who didn't have new money supply that was inflated started getting back in because they saw the government was actually doing something to try and stabilize the economy. The Fed was trying to do something. And then things progressively got better. And COVID didn't get worse. There were like some other COVID strains that people were concerned about, and we had one or two dips based off that. But it was a nice and smooth grind higher pretty much since then. So yeah, thank you for joining my little TED Talk here, my little walk down memory lane. But that's why it's important to understand that the US dollar has different dynamics than a lot of other assets, because it's a reserve asset, because it's linked to the strongest economy in the world, best country in the world, right? I'm American, so I'm going to be patriotic. Best country in the world. But you don't want to get caught. My thing is just don't get caught in the trap in trading the dollar like it's just a risk-off thing. The world can be going poorly, and the US could be doing especially poorly in some scenario. And that would put you at the bottom of the dollar smile, where the US is underperforming relative to other countries, and the dollar will be going down in that scenario. And we have articles in the Discord going over dollar smile index theory, the dollar smile theory. Actually, if you just search dollar smile in the Plan the Profit Discord, again, link to that's in the description. You can hop in and join. You got to go through WAP. It helps prevent impersonators. But what you end up doing is you go join into the Plan the Profit Discord. You search up dollar smile theory, and there are so many different articles and so many different images that I found that describe the theory and explain it so thoroughly. There's a lot of great resources. You could even just Google it and find a lot of great resources. Okay, so we talked our butts off. I talked my butt off about dollar. We went ahead and did the nominal trade plan for the dollar. Now, let's say in the scenario where a deal isn't done, like, I wouldn't be surprised if we... Yeah, I wouldn't be surprised if we closed almost above 100 at some point. I really wouldn't. And the reason being is there's more and more demand for U.S. energy now than there has, if I understand correctly, that there has ever been in history. So I would not be terribly surprised to see the dollar pop up to like here. And that would be an unusual piece of data based off the seasonal information. Now, if we use non-seasonal data, which is why we have this chart, it's not looking much better, except the only thing that I would say is maybe this peak right here. That would be your that would be the spot where bulls tend to stop. And isn't that so unusual? Right, you have a distribution of where tops usually occur for a given week. And you have a peak right here at these red bars. You have a peak right here at these red bars. So Maybe if you're seeing a particularly bearish week, you're expecting your top closer to the open because there's not a huge bullish expectation. Whatever has occurred with a lot of negative expectancy. So you don't see much higher prices above the open. And then you could say this is more range bound or conservatively bullish because let's say you go down. Well, that gives you a lot of wiggle room to then move up to a more, you could say, nominally bullish area. You could see this area actually has the highest percentage bins. So most tops that occur for the week on DXY actually have occurred around this area here. And then you just have this valley, this trough between this peak here and then this smaller but still quite noticeable peak here. And this is probably where you have the highest probability of seeing how far things actually go, of kind of the limit price will move upside to the week for the week until you get into true tail risk territory. Notice how all these percentages are below 1%, while even in this trough, you're at like 1.5%. These odds are triple over here. So this is the tail of the distribution for where tops occur for the week. And my theory as to why we see this bump in the data is because this might just be some kind of historical volatility threshold line where past here you start to see ample selling because this is just a historical place, a historical value threshold line where people are conservatively taking risk off from their trades. So that's how I interpret this spot here. I could be wrong. There could be other reasons, but given the tools that I have here and just what I know about the historical chart data and what I know about other strategies, I would just say that generally speaking, when the volatility pops and you're crossing about this threshold here, the 75 percentile line here for the distribution of where tops occur for any given week here on DXY, that typically around this area, kind of like in a box. So maybe here and here and here. Other strategies have their own so-called 75% line. And so you'll start to see some selling here and some selling here and some selling here and some selling here and some selling here as different strategies have their threshold lines crossed by price or by volatility. There are a lot of different strategies that make money using a lot of different metrics. You don't just have to use this stuff. But if you want this stuff, again, links in the description and all that jazz. So I'd be cautious of going up and to the right if no deal is made. Okay, let's see here. Is there anything else? Because now I've been going on for 50 minutes. I'm ready to kind of head out. I went through a couple of cool things here, but we covered the DXY, we covered oil, and we covered the S&P. So, you know, if there's something you want me to go over now, speak now or forever hold your peace. Had a more bullish expectation for euro dollar, didn't work out. Had a more bearish expectation for New Zealand, and it kind of has held up. We're getting the NYEFU. It's a government budget essentially, and we'll see how it goes, because if this actually doesn't go very well, we'll end up seeing the likelihood of a sovereign credit downgrade in New Zealand go through the roof. So this is actually kind of important for New Zealand long term. It could dramatically impact how what the fair value of the New Zealand dollar is over the next couple of years, depending on how this comes out. I don't know if it'll be an incredibly volatile event the day of, but I know it'll have long-term ramifications for the fair value estimates of the New Zealand dollar. And again, because this is a pair, it's New Zealand dollar versus the US dollar. Even if the New Zealand dollar does take a hit on sovereign credit evaluation from Moody's and S&P, and I believe Finch, right? Well, the US dollar could always get weaker. There are situations where that could happen. You know, the bottom of that dollar smile, and then the New Zealand dollar appreciates. But we'll have to wait and see. Okay. We can look at crypto. Crypto's pulled back from 80K. That's pretty good. Didn't quite follow the expectation timing-wise, but so far, price-wise, it's got fairly close. It's about $1,000 off, and in the grand scheme of crypto, it's actually not that far off, but yeah, and it's also a bit far off as far as time goes, but outside of this up move, yeah, you could say directionally okay. You know, you can fiddle around with looking back in time at these expectations and be like, well, if you want to be generous, you can say, well, you just hold off on shorting until you get up here, and then look at that arrow looks perfecto, right? But that's not how drawing expectations actually work. You're not just graded based on the directional move from point A to point B. You also graded based off the timing of that, and this gets an F. This gets an F. But in reality, if you are holding off until maybe these prices around here, or even maybe more over here, then yeah, sure. All's well that ends well, but you have to set up the expectation that the top actually is over here. Because if you're anticipating the top over here and you're short, you're holding down that drawdown for, $5,000 on Bitcoin. And one thing that we do is we try and place stops in the troughs because the odds are lower. And if we are going to this peak over here, we got to cross the trough. So we try and put our stops somewhere in these troughs before going into the next set of peaks. So in this scenario, here's an example. Getting short around here, just generically at the peak in these distributions, you're putting your stop smack dab in the middle of the trough. Retrospect, everything worked out hunky-dory. You were in drawdown for like a week and a half. But you're sitting pretty, and you were probably hoping for a lot more. So it's probably frustrating for people. And yeah, that was a nice low. I wish I could have just sat on that. But again, that would have been 3 months of waiting. But 30% from that spot to that high would have been pretty damn good. But that's essentially 10% a month. Yeah, that's pretty damn good. I'd say that would have been pretty damn good. But I didn't know if things were going to go crazy lower. But this was a trade, and I have things that are not trades that I don't put on this chart because they're not trades. We have investments as well. Okay. I've now covered a crypto on top of that. The last thing would be to cover a bond, and we could do TLT. And you can see, hey, there's your low, there's your peak in the distribution for the month where the lows typically come in. How about here? Oh, here's your low on TLT where you find your peak in the distribution where your lows typically come in. Yeah, and you're either closing sideways from here or you're rebounding up, and you lucked out over here these last couple of days. Sweet. Sweet, sweet, sweet. Oh, and if you're planning for end of month close, it's probably going to go back above 85. That would be my expectation, above 85 here on TLT. All right, and we covered bonds. We covered all 5 of the major asset classes, except now we have kind of a new asset class with prediction markets, but we're not going to cover that. We use Meticulous. We're not going to get into Polymarket and Kalshi and all that stuff, although they can be very good resources. Okay, you guys, I'll go ahead and say thank you very, very, very much for watching. And I'm happy that we resolved the technical issues from yesterday's stream, covered all the nominal trade plans that we wanted, and did a follow-up about the current situation with Iran with a couple of updates on some of the new developments that occurred since yesterday's stream. So I'm going to go ahead and work on my trading notes now, and I will see you guys hanging out in the Discord. I'll certainly be in the Discord hanging out, just in voice chat for anyone who wants to say hello. And I will see you all in a bit.